Thank you everyone for joining today's webinar. My name is David Kim and I'll be your moderator for today's session. We hope you've been well and healthy in these turbulent times. And in today's session, rather than inundate you with a myriad of facts about COVID-19, which I'm sure you're all well educated on, what we hope to provide today is really a glimpse from the ground in terms of what we're seeing on the market, in terms of both market transactions, leasing transactions, as well as our asset management activities. We are joined today by the following panelists. We have Dr. Chua, Head of Research and Strategy, Stephen Tang, Head of Value Add and Opportunistic, David Blight, Head of Australia, Alvin Liu, Head of China, and Anthony Tang, Head of our Korea office. So before we proceed, we have some house rules. We are going to be recording this session for later playback, so just so that you are aware. Secondly, all of you will be muted as we have a couple hundred dial-ins, but if you have any questions, please feel free to use the chat function to send the questions in, and we'll try to answer them as much as we can at the end of the session. With that, I'll turn it over to our first panelist, Stephen Tang, who will kick it off with what we're seeing on the ground in the Singapore market.
Thanks, David. Hope everyone is well and keeping safe. With respect to what we're seeing in Singapore, for the most part, the retailers and office tenants are still closed except for work from home. There are some tenants that have come back this week, but for the most part, we expect a gradual rollout to happen probably the first week of June. But even then, it'll probably be muted in terms of the rollout and not happen all at once. Now, with respect to what we're seeing with the government measures, they have been quite proactive, the Singapore government, with respect to the economic stimulus packages. And these are really to protect the mid and long-term stability of the economy, protecting those businesses that have been most impacted. These are like retailers and services alike. So some of the examples that we're seeing with respect to concessions would be rental rebates, rent concessions, and then even with the property tax rebates that the government is providing, it's been explicitly clear that the landlords are to be passing the majority of these savings onto the tenants. And again, this is just to maintain the stability, and we do believe in the long run this will be a win-win for everyone involved. Now, with respect to transactions, it's no secret that transactions have been hit pretty hard. We're talking roughly 60 to 65% decreases in transactions in Q1 year over year. Same would be with the leasing side of things. I think viewings are down sharply. Tenants are just not really willing to go out and sign new leases at this time. Now, there was one notable transaction that actually happened last week, and this was for a 50% sale of a very large office building in downtown Singapore, 1 million square feet. Consideration value on a gross aggregate 100% basis was 1.68 billion. And what's interesting about this one actually was the price that was paid for it, which I think if you look at most market observers, they would think that this was a pretty nice price to achieve in normal times, let alone what we're seeing right now during the COVID-19 period. But in general, I think that is a little bit of an outlier. I think most of the people are going to take a wait and see approach, and I think that's going to probably continue through 2020. Now, with respect to valuations, I think realistically, we haven't really seen much valuation changes in Q1, but that primarily is due to the lack of transactions. Most of the valuers here in this region, they tend to take actual transactions as their anecdotal evidence to either mark prices up or down. And so we think that if you look through the next couple quarters, we won't be surprised if we do start to see some adjustments in valuations throughout the course of 2020. Now, with that said, I would say Singapore still maintains a very good fundamental base. If you look at what the economy was doing and what the markets were, as late as Q4 of 2019, you have a very strong market with respect to low vacancy, limited new supply coming on, and basically a very large global transparency ratio with respect to other markets in the region. So we do think that once we get out of the COVID-19, once a lot of this passes, Singapore would be well placed in terms of benefiting from the recovery, from the pent-up demands that we're seeing sitting on the sidelines, whether it's to place capital or for tenants to actually take up new leases. So with that, I will turn it over to Australia and David Blake.
Thanks, Stephen. Good evening, everyone. So look, on the ground here in Australia, we have seen what I'd call a mass evacuation of the CBDs, where physical occupancy across the CBDs we think is around 15%. Trading activity, as you would expect, has pretty much stopped dead. All non-essential decisions have been put on hold. So we've been in isolation for some time, since effectively March 23 or thereabouts. We are now seeing some potential easing of restrictions and a noticeable pickup in activity over the last, certainly the last week. And we're certainly finding that tenant inquiry is starting to pick up. Most of these are tenants who are in positions where they need to move and they need to make decisions, and so they're back out there. And certainly their pricing expectations have changed, and in some cases their space requirements have shrunk a little bit, we've noticed. In terms of price discovery, it's early days. We've had some evaluations come through of the larger pension funds and some of the REITs where they're testing some of their portfolio. But essentially there's no tangible evidence yet. But what is clear is that risk is being priced differently by investors now than it was 2 months ago. There is a gap that's opened up between the vendors and the purchasers' expectations. As far as we can tell, it's probably close to 10%. There were 2 sales campaigns that continued through the period, into the COVID-19 period. Interestingly, they both didn't hit their number. They didn't sell. The number of purchases in both cases effectively halved. And our understanding is the pricing was about 15% off the expectations. So that's an indication of, I think, the significant drop in confidence. We are starting to see, and it'll be no surprise to people, that we're seeing a real hunger for yield emerging. And that's not just a high unstable yield, that's a yield that has a long term and is highly sustainable. And that is, that's quite typical post a black swan event, as many of us would be aware. So we are starting to sense that shift for the longer WALE assets being highly sought after. So look, that's a summary of what we're seeing on the ground here in Oz. With that, I'll pass over to Anthony Kang in Seoul.
Thanks, David. Hi, everyone. Generally speaking, Korea has fared relatively well in terms of the fight against COVID-19. And the country as a whole has pretty much come back to business. However, there continue to be some lingering concerns about the further potential outbreaks. The people and the companies have re-engaged in daily business activities, but with a high level of caution. Korea probably went through its worst trough around mid-March. That's when the equity market and the currency market took a hit of about 30% and 10% respectively compared to the pre-crisis level. However, the markets have quickly recovered since then. And currently, the equity market and the currency are down by only about 10% and 5% respectively, relative to the pre-crisis levels. As for the property market, the leasing and the investment activities held up quite healthily so far, and transactions are continuing to happen, and really with slight or no material adjustments really in most cases. Banks are continuing to lend, and securities firms are continuing to underwrite deals actively. As for the first quarter data, actually, which has recently just come out, Korea actually saw an increase in the transaction volume. Korea recorded about 4.5 billion US dollars in terms of the total transaction volume in commercial real estate space. This was an increase of approximately 12% from the same quarter of last year. We are, however, seeing some pressure building up on the retail and the hospitality sectors, but they are more than offset by the positive momentum that's holding on in the office and the logistics sectors. So overall, the property market is quite firmly supported by the quite deep and the strong liquidity that's available in the Korean market. The liquidity has actually further been enriched by the inability to invest actively overseas. So those have all summed up into the increased liquidity for the domestic market and the focus on the local market. That's the quick overview on Korea, and now I'll hand over to Alvin for China.
Thank you, Anthony. So China was the first country to suffer from the COVID-19 crisis and was the first to implement very aggressive measures to fight it. So the lifting of the lockdown in Wuhan took place on the 8th of April. So if we use that as a basis for the recovery of China, or the start of the recovery, it's been about 5 weeks since then. And so China have had 5 weeks to normalize. The recent May Day holidays, which took place about a week and a half ago, saw a resurgence in retail sales. That actually gave a lot of confidence to real estate investors like ourselves on the ground. So I'll just talk through a little bit of the different subsectors in China and how they have come through this 5-week normalization period and where we are at the moment. So in terms of retail sales, if you let us break it down into the suburban, what we call neighborhood necessity malls, and the destination malls, the suburban malls have recovered faster. In terms of shopper traffic, we are very much, we are very much where we were pre-COVID-19. In terms of tenant sales for these suburban malls, we're kind of at about 80%. So we're not far off from recovery. For the destination malls, these are the malls that sits on top of the transport-oriented hub, on top of like metro lines interchange. They are recovering a little bit slower. In terms of tenant sales, they're kind of at 60% level. Shopper traffic around 70. So we can see that the suburban malls are a lot more defensive, and the destination malls are taking a longer time to recover. We take some comfort that in the last 1 month, there has been a slowdown in new leases being signed. But just this week alone, in a few of the malls that we manage, Dalian, Shanghai, Chengdu, we have seen the on-the-ground leasing team put up new leases for approval. They were very close to our budget expectation pre-COVID. So I think there's a little bit of confidence coming back in the retail market. For the office sector, and I would like to use Shanghai and Beijing as a benchmark because most of the offshore investors invest in office in these two cities. It's actually been slowing down from the middle of last year because of the trade war, as well as the slowdown in China's economy. COVID-19 has further exacerbated these pressures. As of now, the vacancy in Beijing is roughly about 15% vacancy, and Shanghai around 20%. Rentals are down about 10 to 20%. So there is quite a bit of pressure on the office market in Shanghai and Beijing, and we think that this will not recover until the excess supply is absorbed in the next 2 to 3 years. Hospitality took the biggest hit. It was about it was single-digit occupancy during the February peak of the crisis. Now it's gone back up to about 30%. So there's a little bit of recovery coming through the hospitality sector from internal traveling. Last bit, one point that I want to like to add is something that I've been observing on the ground is that liquidity is coming back quite substantially locally in China. There's a lot of monetary stimulus going on, and there's been a 30 bips decrease in interest rate cut up to now. and another 20 bips is expected in this quarter itself. So we think the liquidity that's coming through onshore will be substantial and will help to elevate some of this pressure on demand and rental. So that's generally what we have for China. I'll pass back to Stephen to cover Hong Kong.
Thanks, Alvin. I think when we talk about Hong Kong, it's really a market that's been hit pretty heavily over the last year. This has been materially impacted by the social unrest that we saw in 2019 that kind of carried over into this year. And then with the COVID-19, it was kind of a double whammy that really kind of impacted the overall markets in Hong Kong. Now, in terms of just what we're seeing on the ground also in Hong Kong, is that I think they have done a pretty good job with respect to the recovery process. And I think a lot of this had to do with the impact that the Hong Kong community felt back in the SARS epidemic. So they were pretty much one of the early frontiers and leading the charge with respect to being defensive and proactive with respect to how they took care of the COVID-19 situation. And I think that's starting to pay some dividends as they have had 0 cases over the last 2 weeks, and most of their businesses and retail are actually open already in operation. So that's actually a positive thing that we'd like to see in the market. Now, with that said, you know, the protesters have kind of slowed down a little bit, but over the last couple of days, you know, we have seen the resurgence of this. So the protest volatility is something that we're monitoring very closely. It's something that we can't take lightly. But so we're just seeing if we can see if there's going to be some type of break between the government as well as these protesters over the next couple of quarters. Now, with respect to transactions, you know, there's no doubt and probably not a surprise to anyone that I would say Hong Kong probably has been the most impacted market of all of Asia Pacific. Volumes in Q1 have been anemic, and we're talking down 80 to 90% of what was happening year over year in 2019. And so this is something that, you know, we don't think is maybe going to maintain this kind of rate through 2020, but it's definitely going to be muted throughout the rest of 2020 in the Hong Kong markets. Now, with respect to sectors that have been hit the hardest, I would say hospitality and high street retail have really been impacted materially by all of these various events. I think in terms of actual transactions, there actually has been limited, but if you look at some of the trades that are happening in some of these spaces, we're talking trades getting inked at 50% below asking prices on the transaction side. If you look at it from the leasing front, you know, you're looking at 25 to 35% decreases in leases that are signed in prime central locations. You know, these are things that probably no one would have expected at the end of Q4 of 2019, but they're happening. And, you know, with respect to market dislocations, I would say Hong Kong is the one market in all of Asia Pacific that we are witnessing material dislocation. And so this is something that obviously for investors, we keep a close eye on. Hong Kong is a very fatigued market through the last 12 months. But we do think that there is some green shoots. If you talk to the people on the ground, there is a recent spike in investor inquiries coming into the market, looking to see if there's opportunities to be had. So it is something that, although there's still quite a bit of headwinds, for the right opportunity from a bottom-up approach, there could be some interesting things coming up. So
Thanks,
with
Steve.
that, I will turn it back to David.
Thanks, Stephen. So that was a quick wrap up around the region. If I were to summarize, I think Korea and China seem to be the 2 countries that have the most green shoots emerging, albeit cautiously, with liquidity and the capital markets re-emerging. Singapore and to some extent Australia, low transaction volumes just because transactions are not happening. People are in a wait-and-see mode. Bid-ask spread is still a bit wide, and Hong Kong is still suffering from the double whammy of not only the COVID-19 but also the social protests that have been going on since last year. So with that, we'll move on to our next topic for the panelists, and I wanted to pose a question of what we're doing in each of the markets in terms of some of the measures that have been implemented and how we're trying to stay ahead of the curve. But with that, I'll turn it over back to Stephen.
Thanks, David. So in Singapore, there's several things that we're doing with the existing portfolio. And I think the first one really is just, protecting the home court. And what I mean by that is really with the tenants that we have, it's all about tenant retention right now. I think to the extent that we all want to push rents, we want to get hit the underwriting numbers. I think what we're really focused on right now, just because we just don't have the visibility in terms of what's going to happen, call it in the next 2 to 3 quarters, we're making a concerted effort to make sure that the tenants that we do have in our building stay in our building. And whether these are structuring, tenant leases so that we can get it so that, we can ride through that volatility. Those are the things that we're looking to do. But the key is really to make sure that they don't go anywhere. No one's really looking to go anywhere right now, so we're making it so that it becomes extra easy so that these tenants just stay in place and we maintain occupancy, we maintain the cash flow. Now, in terms of some of the things that we're doing to the actual project itself, it's really making sure that we're positioning all of our assets in our portfolio to maximize the value as we get out of the COVID-19. Now, fortunately, for most of the portfolio in Singapore that we have already been undergoing extensive AEI exercises, capital improvement exercises. And so this is something that was done kind of pre-COVID-19. But I would say even more importantly, coming out of this, it's important to make sure that the buildings are up to speed, up to curve in terms of providing the amenities that we think that the tenants are going to want to have, making sure that the capital improvements, the common lobby renovations are completed, and also implementing new things, whether they're technology, installing apps on all the tenants to make sure that they can get constant communication and services. Those are the things that we're kind of doing within the assets itself. And I would say, lastly, one of our biggest differentiators, I would say, in the Singapore market is just the economies of scale that at ARA that we have here in Singapore, which is just the fact that, within the core areas of Singapore, we maintain 7 assets of large-scale commercial retail assets. And this is something that a few other groups, I could say, have that ability. And that really has been beneficial during this time, because in terms of sharing information with respect to data traffic, making sure that we can try to get synergies with respect to rollout in terms of increased screening and technology screening of those kind of things, we can do that very effectively and probably more affordably than a lot of the others, just given the fact that we have so many assets in Singapore. We can leverage that ability to roll them out to all of our assets, whether they're retail or office. And so this kind of shared technology has been helpful, which kind of goes back to the investor operator model that we have at ARA. So we have our in-house property management team, APM. This has been extremely helpful as well, because of the fact that they sit across all of our assets, this has been something where we can then share information that will be very helpful. So with that, I'll leave it at that, and I'll turn it back to Australia and David.
Stephen, so in Australia, we moved pretty quickly. We took a view very early on that it was better to work with a tenant than try and release the space in what was going to be a very dark period. Fortunately, our platform is predominantly office and logistics. We have a small retail weighting through the Southgate project, and we were very much on their doorstep in the early days. Some tenants, some of the smaller tenants, particularly from food courts, are simply not going to make it. But others, where they had a sustainable position, we have packages of relief that we afforded to them. So we feel pretty good about where we're heading with particularly the retail tenants here in Australia. For the office component, there's only about 20% of our portfolio tenants are what we call SMEs, and that qualify for the package that the government has laid out for tenants. The negotiations are well underway with those tenants, and we would like to have that wrapped up fairly quickly. But I think from a business perspective, we're certainly on top of those nursing of the tenants. The other thing we did fairly quickly, not knowing where the bottom was or is, was we started a great deal of stress testing and scenario testing, and trying to find the bookends of the likely outcomes from a valuation perspective. And to this day, we continue to do that based on what we have visibility of. And if there were any covenants that are going to get challenged through the course of it, which I'm pleased to say there's not. But it's all about securing cash flow and tenant retention. So that's what we're really focused on, as most managers are. We have also moved fairly quickly and pivoted into some opportunities that have arisen as a result of this really sudden impact in the market. And that's particularly in relation to what I call developers who are stranded. And these are developers of metropolitan office projects that we know most of them. Banks have certainly withdrawn a lot of support for the smaller and less well-known, less well-capitalised developers. And so we sense they are stranded and they need help. So there's opportunities from a debt perspective that look quite interesting, and we spend a fair bit of time on that. We also spend a fair bit of time thinking about what the changed behaviours of consumers might be and how that will impact longer term the market. So, for example, we're thinking a lot about metropolitan office, the need for people to be in the CBD. We're thinking about build to rent, or commonly known as multifamily. So effectively that's what we've been doing. I think we're feeling pretty good about where we're at. With that, I will hand over to Anthony in Seoul.
Thanks, David. For Korea, we've been active on both offense and defense side. First, on the defense side, Korea has been quite focused on managing our existing AUM and also the new deals with extreme caution and prudence. For instance, in addition to just doing implementation of various BCP measures at our office as well as our portfolio sites, we have also run a very extensive detailed stress analysis and scenario analysis on all of our portfolio assets, and have made sure that they're all well positioned to withstand any foreseeable shocks. On the other hand, on the offense side, we have been also been quite active in selectively seeking and pursuing new investment opportunities. For instance, ARA Korea is currently in the process of executing a very large, actually the largest office transaction year to date in Korea. It's with the AUM is approximately 1 trillion won, which is approximately about 850 billion US dollars. And we have completed capital raising for that deal, including debt, and we are ready to close in the coming month on that transaction. Also, we have been active in utilizing the downtime to actively reposition some of our portfolio assets. For instance, on one of our portfolio assets, we have initiated proactive lease restructuring and use conversion initiatives in order to optimize the asset and the fund performance. And lastly, we have also been doing the prep work so that when the capital market comes back to somewhat of normalcy, we are well positioned to proceed with our REIT IPO initiatives in the coming year. That's about it for Korea, and I'll hand over to Alvin for China.
Sure. Thank you, Anthony. So for China, as you know, in terms of the retail management, it's very similar to what we've done in Singapore. But I'd just like to add that China, as you know, is one of the places where e-commerce has really proliferated and grown. But I think in our view, retail has also adapted to kind of provide a more experiential environment for people to go and spend time in, so as to draw the kind of dollar spend that consumers will still continue to put into fixed asset malls. So in terms of our retail mall in China, we have tweaked a little bit of the retail offering, and actually COVID-19 did give us an opportunity to, in a way, help us in this, because some of the weaker tenants that were not doing well, they were the first to be weeded out, and then we put in a lot more effort to help the stronger tenants, because we knew that these tenants who had the ability to ride through the cycle of the pandemic crisis, and then they will come out stronger after. So that actually, in a weird sense, gave us a chance to tweak and improve the tenant mix. And most of our malls now, we try to move towards a 1/3 F&B offering, just below 1/3, and a 1/3 fast fashion. And then with the remaining 1/3 split between kids, lifestyle, and entertainment. What's been also quite interesting for China is in the last, say, 2-3 months, there's been a proliferation of local brands that are very vibrant and upcoming, kind of like very hot local brands. So we have also accommodated some of these local brands into our mall. So it's very interesting to see how we fit across the mall and try to have the right positioning to attract people to spend time here. And another thing that we've been quite active in is to, we found more efficient ways to move offshore capital onshore. Historically, most of the transaction from an offshore perspective were the sale of Woofie's shares offshore, and that kind of limited the opportunities that offshore investors can take part in. And in this crisis, a lot of the offshore investors are actually well capitalized. They have a longer holding power. They have their funds are longer term. So if there was distress opportunities or to surface in China, a lot of these opportunities will be local structured opportunities. So we've been more efficient trying to bring offshore money into converting into RMB and deploying as onshore capital. And then once it's done, we repatriate it. So we were also successful in repatriation of one sum of money. So it's not just a one-way street. We actually proved that we can bring in money efficiently offshore to onshore. The last thing is, I think in terms of China, what we've noticed in our experience is that it's very easy to group think. A good investment idea in China, it starts off very well, but then a lot of money rushed into it, and then it gets a little bit tired, and the investors who come in to the same idea at the end usually do not do well. So we try to think ahead of the curve for our investments idea. In 2019, we were quite bullish on Chengdu, suburban retail in Shanghai, as well as logistics, where the group invested heavily in a partnership with Logos. And in 2020, we identified credit as an interesting way to play Beijing and Shanghai office exposure. So we try to look ahead of investment ideas to make sure that we stay ahead of the pack. So that's what I have for China. Can I turn over to Stephen for Hong Kong?
Thanks, Alvin. So for Hong Kong, we're a bit fortunate in that in terms of the overall portfolio that's non-REIT related, we actually have a very limited exposure to Hong Kong at this time. But we do have one remaining asset in a legacy fund. And for the most part, what we're doing in Hong Kong is very similar to what we're doing in the other markets. It's really just trying to protect the cash flows and to make sure that we kind of right-size the tenant mix. So this could be, for example, taking some larger floor plate F&B tenants that may not have been doing well and proactively looking to see if we can find opportunities to cut up the spaces, but not just to cut up the spaces, but to also see if we can find tenants that are going to be more future-proofed, whether they're kind of what Alvin alluded to in terms of experimental retail or some e-commerce related activities, or even with respect to some of the markets in Hong Kong where this particular asset is located, you know, some type of distribution center for the e-commerce activity that is going on. But for the most part, just trying to make sure that we get the assets to be in the best performing position that we can as we get out of the COVID-19 situation. Now, with respect to new deals, there's a couple things that I want to focus on. The first one is really, we're just keeping close to the basket, so to say. And this is talking to the vendors, you know, constantly looking to see what they're wanting and what's the kind of market is like. I would say if you look at our current acquisition pipeline, most, if not all, of the projects that are in the pipeline right now, we have been engaged with these vendors over the last 6 to 12 months. And this has really come to roost right now with respect to now you have the COVID-19 situation and there's new investors coming in and trying to come into the picture. And the vendors are actually calling us right now because we now have a sense of normalcy and credibility that these vendors have said, look, you guys have been talking to us now for the last 9 months. We know you're real. We know that you understand the market. And this has actually been very, very helpful with us in terms of our current sourcing of deals and trying to get prices that are going to be attractive to us on a move forward basis. And in terms of the sectors, I would say that we're looking at, it really, if you look at Hong Kong, there's still going to be a lot of volatility, and that volatility we think is going to persist. And so what we're looking to do is really find sustainable sectors that we don't think are going to be too caught up with the whims of the global markets. So with respect to kind of office tenants that have a lot of international tenants, I think those are things we're probably not going to be as keen on right now because we just don't know what's going to happen in the global markets and we don't know what they're going to do with leases. So what we're really looking to do is focus more on the domestic consumptions, focus on structural inefficiencies. And these are really things that we feel are specific to Hong Kong and essentially just creating a better mousetrap for what we currently have in the marketplace right now. And I'll get into that a little bit more in terms of opportunities that we're seeing. So with that, I'll turn that over back to David.
Sure, thanks. So to sum up, you may have heard this from other fund managers, but basically tenant retention seems to be the main theme. It's interesting when we run the various scenario analysis and we debate whether to stay put in terms of our vacant spaces in order to try to get a higher rent. The cost of doing that in terms of tenant incentives, rent freeze, etc., versus retaining a tenant, albeit at a lower base, works in favor of tenant retention. Probably true in a lot of our cases, but this is really where, again, defensive cash flow seems to be the key. And that's something that we've been approaching with our lenders as well. And we started the discussion with the various lenders almost 6 months ago in advance of this as we variously stress tested all the scenarios. Something that we're trying to stay on top of. Banks are a bit cautious, and we'll get into some of the more detailed nuances in the various markets during the Q&A session. But again, bankers don't want to be surprised, and that's needless to say where we come into play with the various stress tests of the various cash flows in all of our assets. So with that, we'll move on to the final topic before heading over to the Q&A. I'd like to pose a question to the panelists in terms of the opportunities that we could potentially see in the various markets that you're operating and what that brings in the post-COVID-19 world. Stephen?
Sure. So I'll take Singapore first. So in terms of opportunities, I think if you just look at the market fundamentals, at least in terms of Singapore, we are stronger today than we were in those two previous cases, both in respect to lower vacancy rates as well as kind of upcoming future supply. So we do think that because of these various factors, when you look at prime centrally located assets, commercial assets, there should still be some wins going for it as we get out of the COVID-19. And so I think it's just a matter of obviously market timing right now, but we do think that centrally located offices still has its day in court. Now, one interesting thing that's happening is, as everyone knows, with respect to yields in Singapore, I would say that has always been historically quite low. And the Singapore government recently wanted to really, as part of their initiatives to redevelop the core CBD, introduced a redevelopment plan in 2019, which I think is a very unprecedented with respect to their ability to try to create a revised live, work, play, and environment. And what that really means is it allows the landowners or the building owners of buildings 20 years or older to essentially redevelop their assets. And to the tune of a 25 to 30% increase from existing plot ratios. And what this really represents, in our opinion, is an unprecedented opportunity for investors to kind of come into this market of Singapore and take advantage of this ability to get an outsized product based on the initial purchase price because of the increased plot ratio in the GFA. But more importantly, because of that outsized GFA, they could really benefit from getting stronger yields than one would actually find in kind of existing stock. So this is something that we're keeping a close eye on with respect to opportunities that may emerge that will be able to fit within this bucket. And I would say lastly, this is really goes more towards the transparent rule of law here in Singapore. If you look at the technology market, Singapore has attracted a majority of the corporate headquarters in Asia Pacific to come into the Singapore market. And I think it's because of the fact that it's transparent, it has good rule of law, and that ultimately transcends into ancillary requirements such as data centers and those kind of things. Now, the digital real estate, we believe, is very, very applicable and appropriate for Singapore. Now, there are various challenges in the Singapore markets, and I won't get into it on this particular call, but with respect to restrictions of the government and whatnot. But we do think that if folks can kind of get over that particular restrictions and find a ways to get around various power supplies and so forth, the digital real estate market in Singapore could also prove to be interesting. So I'll turn it over back to David Blight.
All right. So in terms of the opportunities and where they will lie, I think the first thing we've seen is that the trends that we knew were starting have really accelerated with COVID-19. So in particular, e-commerce, there's been a significant increase in the usage. I think the skeptics of e-commerce, I think, are well and truly now converted. Retail, the impact on retail, as we know, has been profound. The business model of many retailers has been broken and needs to be pieced back together probably in a different way. I think it's clear that it's very difficult for retailers to rely purely on a bricks and mortar presence. You really do need to have an online presence now as well as a physical presence. But what we're applying a lot of thought to is how will the retail hierarchy evolve in Australia, given our fairly strict planning regime. And for those of you familiar with the Australian market, there's clearly three tiers. So regional centres that are very, very large shopping centres, they are really focused, I think, on entertainment, on moving away from discretionary spend, focus on the community. They've become the parks of the 21st century. Neighbourhood centres really, I think, have found to be quite resilient during this process. Convenience-based, local community support, I think they've found their place well and truly in the hierarchy. The area we are a little concerned about and trying to figure out where the value equation sits is in the sub-regional centres that sit between neighbourhoods and regionals. And there's a lot of real estate in Australia that is in this category. And it may be that these need to be reworked with mixed use options instead of purely retail. For example, apartments on top, or a health precinct or medical precinct or something like that. So retail, we think, is really interesting. Office space, obviously we're seeing the reduction in space per employee over the last 20 odd years down to about 1 per 8 square metres. We do expect that to pull out a little bit in light of the 1.5 metre personal spacing requirements. So it may drift out to 1 to 10 to 12. That might lead to greater space requirements, but I think then with working from home experiment, as successful as it's been in Australia, you'll find that that will probably shrink the overall tenant demand for office. The other sectors we're really interested in, I mean, credit, as I mentioned before, looking for opportunities where you can be the senior debt in the capital stack. and get double-digit returns, we think that can be really interesting. Senior living is a space we've been looking at for some time. That's where certainly the downsizers in Australia, events like this historically have provided for people to accelerate their decisions to generally downsize and to live a better life. And we think one of the upshots of this COVID-19 will be that many in the middle market will seek to do that. And so we see some accelerated demand for what we loosely call senior living. Similarly, metropolitan office, we think that's really interesting because we think a lot of tenants will question the need to be in the CBD, particularly with the remote working experience being as successful as it has been. The need for people to congregate in the office in the CBD is probably limited. The other two sectors, build to rent, is a demographic trend which we think will accelerate. People will focus less on home ownership, and obviously logistics, as we've talked about. So I'll hand over to Anthony now.
Thanks, David. For Korea, we expect the core and core plus office sector to continue to perform very stably and solidly into the post-COVID crisis period, mostly supported by the strong local liquidity, like as I mentioned before, and the strong fundamentals and the low interest rate environment. The second area of potential opportunities would be in the logistics and the data centers. So like most of other developed countries, we're seeing the current kind of accelerated digital transformation trend to create further new and strengthened demand for these sectors. And we believe the same would be true for Korea going forward. Another area of potential opportunity would be in the REIT IPO market. We had witnessed that actually quite a strong REITs market just up to the COVID-19 crisis. And we believe that as soon as the crisis subsides, the market will come back and the REIT IPO activities will pick up actively again. Lastly, we do expect the outbound investment activities to pick up sharply as soon as the borders start opening up again on the major markets. This is somewhat inevitable for Korea, given that the local market is very limited in terms of size, especially relative to the depth and the breadth of the liquidity that's available. So the capital really has no choice but to look outside the borders. So as soon as the borders open up again, we believe the outbound activities will pick up quite actively. That's all for Korea, and I'll hand over to Alvin for China.
Sure. For China, logistics has been a favorite subsector, and it will continue to be. I think logistics has benefited from this COVID-19 because of the increased penetration and sales, online sales, as well as the need for more storage space to overcome this supply chains issue. But also another point is because for China per se, a lot of the local liquidity in China do not classify logistics as real estate. The local government regulations are still very tight on liquidity, trying their best to tighten liquidity, prevent liquidity from flowing to real estate to feed the bubble. So logistics actually falls outside of this space. So a lot of these quotas on real estate, be it the onshore trust companies, the investment companies, or the banks, do not apply to logistics. So we would see a lot more liquidity for logistics coming through from local channels. At the same time, I think about 2 weeks ago, China implemented a draft of their REIT code. This REIT code mainly keeps out residential and commercial real estate and applies to infrastructure, whereas logistics actually falls under infrastructure. So again, there'll be more liquidity onshore to facilitate the sale of logistics. So I think it will continue to be a very attractive investment opportunity. The other one that we've been quite keen on is credit. We view credit secured by high quality commercial real estate as more of a way to take an exposure to such real estate. I think in terms of Shanghai and Beijing, where if we were to buy, prices are actually at a pretty high level, especially for office, and rental growth assumptions, as I mentioned earlier, it might be difficult to substantiate growth in valuations in the next 2 to 3 years. So if we had the opportunity to put out credit opportunities, mezzanine opportunities secured by office in Shanghai, Beijing, we think the risk return actually works quite well. And then the last, I think retail is a very, very challenging market subsector in China. A lot of GPs and even local players stay away from it, but to us, there is still an opportunity there. I think if you think about all the distress or all the NPLs that will come through, or it says that it will come through in China, most of it is going to happen in retail because there's just very little operators who actually can make some of these distressed retail work. So I think if we were to see through and look for the gems, I think retail would be one that we'll spend quite some time on. And some of these opportunities, we can actually get it at replacement cost and below. So we think it's still a place where we'll spend some time on. Thank you. Steve?
Sure, thanks, Alvin. I think, when it comes to Hong Kong, just given the extended economic uncertainty, there's inevitably going to be some opportunities that we see emerging out of that particular market. Now, if you look at some of the deals that are happening right now, we're talking about transactions, as I mentioned before, at 50% below asking price. But more importantly, some of the deals that we are actually engaged in currently, 1 or 2 assets that we're talking to the vendors, they're looking to sell at not only 50% below the asking price, but 50% below their entry price. So this is something that is obviously unprecedented, and I think it's something where we still have to tread carefully, but it's something that we do think there could be some opportunities from a bottom-up approach, and we're pursuing those currently at this time. Now, obviously for everything that we buy, we're looking to find ways of how we can improve the asset once we acquire it. And I think Hong Kong in particularly actually is a pretty good market for that, because given the fact that a lot of the prime assets in Hong Kong, they're actually located, or they're held by large families that have held it for generations. The projects are very dated. So there's an ample opportunity for us to kind of go in there and do redevelopment or repositioning of a lot of these assets that we think is going to be appropriate, in terms of moving forward. And so these conversion plays, with the right entry point, we do think can show some promise. Now, obviously, there's going to be several sectors that we think are a little bit more resilient, especially during volatility, than others. I think it's proven to be that the residential sector across the board, in Hong Kong included, is actually performing quite well during these times. So this goes back to my earlier point in terms of providing structural solutions into the marketplace, whether they're through conversions or whatnot. So this is a particular area that we've been focusing on, just in terms of just kind of getting adequate options for the local community and those people living in Hong Kong for one of the priciest residential markets in the global system. We think that there's opportunities if we can buy it at the right prices, at some of these prices that we're talking about. This could bode well for long-term investment gains. So I'll leave it with that on Hong Kong. And if there's obviously any questions or you guys are interested in talking to us more on Hong Kong, please let us know. I'll hand it back to David now.
Sure, thank you. So that wraps up the main 3 parts of our session. Before I turn it over to Dr. Chua to discuss some of the further macro trends, if I could ask him to also help answer our first Q&A, which is basically coupling some of the queries with regards to the macro trends to consider and the outlook for real estate activity in Asia Pac for the upcoming year. Dr. Chua?
Sure, thanks, David. So the first question pertains, I'll just address the first questions relating very much to the transactional volume in Asia Pac and the outlook on the property market. I think for some of you who are following the the debate out in the market, definitely volume of transaction has softened according to RCA data. It's actually softened by about some 50% on year. Although, having said that, this is actually not the largest you have seen. The largest was during GFC. That was sometime about the fourth quarter of 2008. At that time, it fell as much as 74%. But subsequently, within 4 quarters, it recovered fairly quickly, between 79% recovery after 4 quarters. There was a systemic failure in the market at that time, the GFC. What we are seeing right now, this COVID, it's actually more both a health issue as well as adjustments to the market fundamentals as well. And so I think exactly when it will recover, how the markets will respond, remains to be seen. But by and large, I think we have seen market players adopting different measures as a result of the social distancing, the lockdown and no travels allowed. We have seen technologies being applied to sales transactions. Although having said that, some recent news reports in Singapore, they tested using virtual tours as a way to launch new products. Hasn't been that well received locally yet. I think the underlying concerns is really about, for most investors, is really waiting for some clarity in the market, where things are going to head. So it's a lot of wait and see, as my colleague earlier mentioned, Stephen, about wait and see before they plunge into the market at the moment. Anecdotally, we hear too that some regional funds based here in Singapore looking to exit the market have also held back their sales at the moment, waiting for some clarity, given the fact that the investment pool is a lot weaker now as compared to, say, 6 months ago. If I may, I'll just kind of, I thought, before we wrap up this webinar, I thought I'll give a kind of a high-level summary of what I observe in this trend right now. You have heard from our country leaders already on the various strategies we have adopted. In some ways, that kind of echoes what we are seeing at a larger scale in terms of where the governments of various countries have adopted. They are very disparate. You hear government pumping in as much as 20% of the GDP as fiscal measures, as in case of Japan, to as low as just 3.5% in China. And that reflects the underlying differences in the way the economies are responding or reacting to this COVID-19. So to me, COVID-19 goes beyond just a general global health issue. It has definitely disrupted consumer behaviors and business functions and impacted on the economic balance, especially between consumption and production. That means I'm talking about the demand and supply side of the economy. One thing for sure, the governments are not only faster to respond this time around as compared to GFC, the stimulus packages are a lot bigger. So according to the Center for Strategic and International Studies that's based in the US, they estimated that there are some USD 6.3 trillion of fiscal measures right now, a majority of which is pumped into supporting government spending, that is supporting the industries, direct grants. And then there's the other part of it to credit enhancement programs. So again, to support some of the businesses may face some financial difficulties, and the rest of it's on tax incentives, very minor, it's about 0.8 trillion. So in terms of fiscal measures, it ranged from, like I said earlier, 20% in Japan to a low of 3.5% in China. But interestingly, these measures have seen in both Japan and Australia, for example, what they spend today as fiscal measures, stimulus, is a lot larger than what it was back in GFC. For example, in Australia, back then in 2008, it was just 4.1% of the GDP. Today, we are looking at about some 10%, almost 10% of the GDP is used to stimulate the economy. China actually buckles the trend. It's just spending 3.5%, and in fact, it's lower than what they did in the GFC. Back then, they spent about 8%. So to me, I think there is definitely some levers that the Chinese government can continue to spur their local economy going forward. But circling back to the larger market, I've also identified 4 key trends for you that kind of circle around what I mentioned earlier, the substitution of demand and the business resilience. Substitution of demand has been set in gear. We've seen that happening already. Consumers are likely to retain some of their behavior post-COVID. For example, e-commerce and online lifestyle. These are opportunities that will present itself very much in the digital transformation space. For example, 5G technology, the data centers, the social infrastructure, and the digital network infrastructures. On the economic resilience, I think firms have started to decentralize operations and hold backup operations like we have seen in post-tsunami back in Japan in 2011. The just-in-time production is definitely losing its shine. To safeguard the supply chain, firms will start to hold inventory and distribute their operations regionally, hence supporting logistics and warehousing around the region. The social distancing measures we have seen is likely to remain in place, and so is a rise of alternative work solutions and new retail concepts. This will definitely further boost the growth of e-commerce and remote working. But what does that really mean for retail and office space? Well, the jury is really not out yet at this moment. I think there could be some downside risks as firms attempt to consolidate and introduce work from home measures, all part of cost saving strategies in a very much dislocated economy. On the retail side, I think we can expect a lot more integration. Omni-channels retail is likely to take the forefront, and it's not just the retailers' problem, but landlords and owners will start to take an active role in the business of this omni-channel. So going forward, I think with the rise in urbanization and change in consumer behaviors, I think retail will no longer be just a real asset play, but also the business of retailing. With that, let me pass it back to David.
Sure. Thanks, Dr. Chuan. So in order to wrap up, I'm mindful of the time as well as we approach the hour mark. Basically, as we go around the region, we see opportunities still in the office sectors and logistics. Hong Kong seems to be the most stressed or distressed, I should say, with opportunities that we see not only in the commercial sector, but also in the hospitality sector. With that, we'll jump into the Q&A. If we could have some of the questions up on the screen, perhaps, so that we give our panelists a chance to answer. One of the first questions that we are seeing is with regards to banks and what we're seeing on the local grounds. Perhaps we could go around the region just to give a quick highlight to see what kind of discussions we've been having with the various banks, if there's any notable change in stance and terms and conditions. Perhaps I'll start with David White in Australia.
So as part of our process for shoring up the portfolio, we've just finished a survey of our lenders, all of our lenders. And in a nutshell, what we've found was that the bank margins are up about 100 basis points. That's been offset by the base rate coming down by about 50 basis points. The LVRs are dropped between 5 and 10%, and there is generally a flight to quality from the lenders. So the banks are being very selective about who they will lend to. So we've got a lot more detail on that if anyone else is interested, but that's the summary of what we've found.
Okay. Thanks. Anthony, if I could direct the question to you in Korea, given the current strong liquidity, are you seeing any changes in the bank stances?
Yeah, the short answer is no or not much. Bank of Korea had recently lowered base rate by actually 50 basis points. However, that 50 basis point cut has not fully flown down to the actual lending level, which means that perhaps the banks are pricing in a bit more risk premium. However, generally speaking, the debt is really available, and relative to where the banks were maybe The terms and conditions being offered by the major banks have not really moved or changed. This also applies to LTVs. We have not seen the LTV drop. As I mentioned, we are typically in the process of executing a very large transaction, and we have not had any issue in terms of financing the deal.
Okay, thanks. Finally, we'll go to China with Alvin just to see if there's anything with regards to the Chinese lending markets.
Yeah, actually for China, our ability to lend and the support from the banks have actually been one of our competitive advantage. The foreign banks are still very keen to lend to Chinese sector, but it's very hard for them to onboard new clients. So they look, to share some of the liquidity that's been going to them with clients like ourselves who have a long-term relationship with them. In terms of interest rate, I mentioned before, 30 bips down this year, and I think by this quarter there should be another 20 bips. So all in, if you talk about 50 basis points of borrowing rates of say 5.5 onshore borrowing, it's actually quite so. Strangely, the liquidity has actually been a boost for us. Thank you.
Okay, thanks, Alvin. Why don't we move on to the next question if we can? Have increased. Do you expect cap rates to come down to similar levels as GFC? If I could ask Dr. Chua to help us answer.
Sure. Sure. I think at the moment, the yields in the market have actually kept quite stable if you look at the recent report again by RGA. And with the kind of liquidity in the market, most of them are going to be supporting, I believe, in supporting the business at large, the economic businesses at large. Will it cause further yield compression? I will not dismiss some marginal yield compression going forward, but I think in the meantime, it's likely to remain quite stable as what we have seen over the last couple of quarters. The yields have been held quite stable, and even in the first quarter and second quarter prelim numbers, yields across the region have held quite flat at the moment.
Okay, thank you. Do we have time for one more question, perhaps, before we wrap it up? Okay, have you noticed fire sales on behalf of pension funds? Alvin or Dr. Chua, perhaps?
Sure. I'll just kick off with what I've seen again from the number of passed to Alvin. I think so far the fire sales I've heard largely came in a lot more in China. China, about a third of the transaction volume deals I've seen in the first and second quarter comprise fire sales, but largely driven more by corporates than pension funds. And I think that's because of the fundamentals, economic weakening of exports have affected some of these corporates, which resulted in them liquidating some of their assets. Alvin, you'd like to add?
Yeah. Just one, when we talk about deals in China, like I mentioned earlier, we're actually able to do both the onshore and offshore structure. We've been more conversant in looking at opportunities in both ways. I would say for the offshore structured deals, there is less pressure, and I don't foresee huge fire sales because the offshore investors have traditionally had longer term funds. They typically have longer holding power, and most of them are institutional in nature. If there were any distress, which we think there will be some coming up, is really the onshore held assets, because a lot of the onshore funds in the last 3 years, be it private space or some of the quasi-REITs that were actually financings, a lot of them were actually raised based on very short-term capital, and many of them from retail investors. And these retail investors, if they don't get their money back at the end of 3 years, it's not pretty, it gets very ugly. So I think there'll be some of these local structured funds that will need to sell distressed assets in a bit, maybe in the next, say, 6 months. It's just going to get more. Thank you.
Let me just add further that in terms of pension funds, fire sales, I think so far we have only observed in the market is those pension funds in Europe that are redeeming from their investments. But we have not seen that kind of activity so much here in Asia Pac yet.
If I could have David Blight chime in for Australia, given the larger exposure of the pension funds there.
Yeah, thanks, David. I just wanted to say, just in answer to this, it's been speculated quite a lot here in Australia that there would be some fire sales, basically because the government has permitted the individuals to withdraw up to $20,000 each, and it's led to a significant withdrawal from the cash component of the pension funds, which, coupled with falling equity prices, has increased the weightings of real estate and also put some more demands on liquidity. So whilst there's been speculation, most of the well-managed pension funds do hold quite a large amount of treasuries and cash. So I don't really expect there to be fire sales, but I do expect to see some mergers between some of the mid-size pension funds as a result of this experience.
Okay, thanks very much. So with that, we'll wrap it up here. I know this was a bit of a whirlwind, a look around the region. We're happy to have one-on-ones with you all for further questions and deeper dives. Please email us to arrange such a concentrated exposure and discussions with any of our regional heads. We will be sending this recording link along with the materials that were presented today to the email group. But in the meantime, thank you all for participating in our webinar. Stay safe and be healthy. Thank you.